Cashflow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Hey, good evening, everybody. Welcome to Oregon Cashflow Pro. My name is James Barber. I'm here to help you maximize your cash flow, especially at this live stream because this is our Wealthcare Wednesdays, where we talk about all things finance. So if you've got questions, we're going to do our best to answer them, and we'll just do our best to help you out. Our goal here is to help you maximize your cash flow, understand finances, dynamic banking, infinite banking, life insurance. If you've got car questions, hey, we'll try and help it out, mostly with financing or leases. But we have a wide range of experiences and depth that we can draw from in order to help you solve the problems that you face. So, it's good to see you guys tonight. Wouldn't be much without you. You make up this show. This is all about viewers' questions and comments. Top Gun, how's it going? Hopefully the sound works okay. Let me know so I don't start talking forever without having proper audio working. On my side, it looks like everything is working good. So somebody just give me a thumbs up. Okay, sound is good. Sound is sound. Right on. So we do have one viewer question today. Another one from Top Gun Bobby. Apparently you're the only one who's figured out how to leave a voicemail message, which is cool. It's better than nothing. It'd be nice to get some fresh voices in here, but I'll take what I can get. We end up with a lot of good questions throughout the night on these. So if anybody has any questions, don't be shy. Put them in the chat. But if you're interested in winning a prize, namely one of the two books that gets listed in my descriptions, or a t-shirt from my Teespring store, go to my website, OregonCashflowPro.com, and there's a button right on the side where you can click to leave a voicemail message. Pops right up. You don't need any special equipment. You can just leave a voicemail message right there. So check that out. And if you leave a voicemail message and I use your question during a live stream, you get a prize. And it's your choice. So Top Gun has already gotten a couple of sweatshirts, a t-shirt, and he's going to get another one because he's the only one that left me a voicemail message this week. I would love to get some more of these out there to you folks. So if you're interested, I don't know, maybe you guys just don't like the design. Oh yeah, you can get the socks. You can get the socks for sure. You needed a pair. Nice. I haven't tried the socks from there, so you'll have to let me know how it goes. Have to let me know if they're comfortable or not. He does like his sweatshirt, though. Darren, never watched you at night. This is odd. Yeah, this is different. So I basically live stream every Wednesday evening. This is not focused on the stock market. This is focused on finances. And really, any questions you have that maybe I can help you out, we want to do our best to try and help you achieve financial freedom, maximize your cash flow, eliminate your debt, grow your wealth, whatever we can do. My time here is yours. Rez, how's it going? Loves to watch my videos and live stream. Thank you. I appreciate that. I love doing them. So I really enjoy this. I really enjoy helping people out as whatever way that I can. And I like to think that I'm providing some value. So I appreciate you letting me know. Top Gun, he'll let me know if the socks are dad approved. All right, nice. Northwest Pearl, good evening. Top Gun asks, can you explain how you would go about funding your kids' IUL? That's kind of a broad question. So me personally, I like to design a policy for my kids, or really any kids. The reason I like IULs for kids is because we can fund them at a very low level and get really good growth out of them. when it comes to life insurance policies, the key to getting good cash growth in the policies, one, you have to have a permanent policy that has the ability to grow cash. But two, we need to minimize that cost of insurance, because everything you're able to put in above the cost of insurance is going to have the opportunity to start growing. And the way that I design policies, we minimize that cost of insurance so we can maximize that cash growth. And that gives you cash available even within the first year. I'm going to be putting a video out. I'm going to be putting a video out because I just came across a video, or not a video. I just came across an illustration and an actual policy of a universal life policy that was not designed well. And this client started it 5 years ago, did not buy it from me, obviously, because I only design the best policies. He started it 5 years ago. He's been putting $7,200 a month into this policy. So he's now at $33,000 he's put into the policy. He has no cash value available in that policy. He can't take a loan, and he can't do a 1035 exchange because there's nothing to exchange. There was like, over the course of the last 5 years, there was over $14,000 in charges, not including the cost of insurance. That's like administrative charges. He's got a $19,000 surrender charge this year, like right now, $19,000 surrender charge, which is offsetting what little bit of cash growth that he would otherwise have in the policy, which I think it was like $11,000. So really, really poorly designed policy. He's not happy about it now, and he had no idea. He had no idea that it was going to be designed that way when it was sold to him. Because obviously, insurance agents can make these policies sound good. And really, most of these policies will look pretty good if you just compare them to like a savings account and you have people ignore the value of them for 20 or 30 years. Problem is, people don't ignore the value for 20 or 30 years. That might be all that you show them in the illustrations. But when reality hits and life hits, and they may need access to some of those funds and they don't have it, that's a challenge and that's a problem. And it's one of the reasons I like to design all of my policies to maximize that cash value, especially early on. Because what we've seen is, if we maximize that cash value in the beginning in year one, it's going to maximize the cash value from then on. The policy just performs better every single year. And what is it in that design that maximizes the cash value? Minimizing the cost of insurance, minimizing the agent's commission. So in this case, that agent, I think that agent got probably about a $7,000 commission on that UL policy. And because that agent prioritized their commission, maybe they didn't know better, but I think it's up to us to make sure that we know better as agents. But because that agent maximized their commission, that person has no cash value for the first at least 5 years that they can access. And the company that they put them with has massive surrender charges. Like, that's just ridiculous. So I illustrated how I would design that policy 5 years later. So they're 5 years older. And I can do that same policy, the same amount of money to put in, and it turns into like $5,000 cash value in the first year. You've got about a $2,000 surrender charge that it doesn't get any bigger than that, and it goes for a couple years, and it gets smaller and smaller each year at that point. So if for some reason 5 years down the road they want to get out of this policy, they've put in $35,000, and they're going to be able to pull out over $35,000 after the surrender charges. Like, that's how the policies should be designed. Really, if it's designed right and it's like that, they won't even want to pull the money out because it's actually performing how it should be performing for them. So back to the kids. The reason I like IULs for the kids is because we can really minimize that insurance cost. So I can do a design on a kid's policy that even if you're only putting in $100 a month, if we start when they're basically under 18, but if they're, let's say, 14 or 15 years old, by the time they get to be retirement age, 65, and they put in $100 a month that whole time, they could potentially retire with an income stream of $60,000, $70,000, $80,000 a year every single year until they pass away. If they're 2 years old and you do that $100 a month, they could potentially have $100,000 to $200,000 in an income stream at retirement. So I mean the amount of money that these policies can generate, because they have guarantees against going negative with any type of with the index going negative in the stock market, when you take out the possibility of losses for that, it makes the compounding that much more effective. And there's some really good policies there. Now, a whole life policy, I really like whole life policies, but when it comes to cash growth, that underlying cost of insurance is higher. So they're not going to get the same type of performance even over the course of 60 years because you just don't have that same growth potential. So I like the IULs for that, and funding the kids' IULs, I basically just fund my kids' IULs at $3,000 a year. And I just pay it annually. But once you get it started, it's really flexible. So we always design it so that it's max funded. So I can't put in more than $3,000 a year. That's going to be the most that I'm able to put in for that one particular policy. Now I have a couple policies, and it's about $3,000 for each policy for each of the kids. So I'm up to close to $6,000 that I'm putting in for each kid. And to fund that, I just fund it like I do anything else. I get the money from wherever I have it available when the premiums due. So I tend to flow all of my income that I can through my life insurance policies. So I look there in order to fund the other policies as my premiums come due. So that's how I cover those IULs. Now, if I happen to get paid right when that premium's due, I'd probably just use what I get paid and put it in as new premium, assuming I'm already at my MEC limit on all my other policies, which for this year, I'm at my MEC limit for all my policies already. And this month, coming up in just a few days, is one of my renewals. So I will be funding it with, I'm actually going to try something new this time, actually. I'm going to try funding it with a credit card. I was looking at plastic.com, and it looks like they will fund a life insurance policy with a credit card. Charge me a few percent interest, but that's okay. It's like 2.8% interest, and I have a credit card that I have a 0% interest on. So I can fund it, take that year to pay it back, and in the meantime, it's growing interest in my policy. So I'm gonna give that a try. We'll see if that works. This will be my first time trying it. Let you guys know how that goes. But that could be a way that you fund your policy. Not every credit card will work for that, though, I don't think. So I have a Chase credit card, and it talks about cash advances and the amount that it charges for a cash advance. And under that section, it says a cash-like advance. And it says that includes third-party payment providers. To me, that sounds like they're targeting plastic with that. So it's possible if I use plastic with that credit card that they will charge it to me as if it's a cash advance, which is not the 0% interest rate. And it's, in fact, an excess of, so with that card, I have like a 13% interest rate if I run a balance. I have a 0% to start with. But if I do a cash advance, it's like 24.99%. So that is not something I want to have happen. So we got to make sure, check your credit cards, make sure you're not going to get in trouble doing it that way. But might be a good way to fund it. All right, let's see. Northwest says, speaking of kids, mine is 2. What can I do to help create some security for her future? That's a great way to do it. So one of the advantages of funding an IUL for the kids or on the kids is they're not old enough to qualify for a Roth IRA. I love Roth IRAs because we fund them with after-tax dollars and they grow tax-free. Well, an IUL works very similar to that. We fund it with after-tax dollars. It grows tax-deferred. And as long as you access it through a policy loan, you end up never paying tax on it. So it ends up being very similar. And then when the person who's insured on that, when they pass away, the death benefit goes tax-free to the beneficiaries. So it's a great alternative to a Roth for kids who can't qualify for a Roth. It's a great way to get started. You get that tax-free growth, and of course we get that death benefit. It's unfortunate, not something we want to talk about very much, but sometimes kids pass away when we least expect it. And that can take a major toll on the parents and their income producing ability. So a lot of people may talk about their not needing life insurance on kids because they don't make any money. And a lot of your financial gurus and people in the FI community will say, you don't need insurance on your kids. They don't make any money. You only need to insure the income producer in the family. Well, I disagree with that because if my kid passes away, that's going to hamper my ability to provide income because I'm probably going to need some time to grieve. My work, even if I try and work through it, may suffer. I work on commission-only basis, so my payments, my income may just dry up completely during that tumultuous time. Now, that's not good. Now, if my wife passes away, same situation. Or if the kids pass away, both parents are going to be affected by that. I think it's safe to assume that there's going to be an impact on somebody's ability to provide financially in the event that happens. And the way that we give these parents time to grieve is by having that life insurance available. There could even be other kids in the family that are going to need some help during getting through that time. That may be therapy. Maybe if the parents are grieving, they're not giving them the attention they need or the help that they need with homework or whatever. So maybe you need to hire a nanny. Maybe you need to hire somebody to help clean around the house. Maybe there's just a whole bunch of other expenses that could be a possibility if the parents are down and out. So I'm a big fan of having life insurance on everybody in the family because when it comes to insurance, we're insuring against the worst. We don't know who's going to be the first to pass away. We definitely want insurance on the parents first because that's going to be the biggest impact. But as we expand our policies, we want to make sure we get everybody covered. That way all of our bases are covered. We don't have to worry about it. Top Gun says, whoever designed and sold that policy to him should be taken to task. Yeah, I agree. And you know, like I said, it may not be that insurance agent's fault. They just don't know any better. Because these insurance companies do not train you how to properly design a policy like I design it. Because it minimizes the agent commission. Which means it minimizes the commission that whoever, all the layers above me within that company, it minimizes the money that they're going to make as well. So there's some companies out there, and I'm not a big fan of them, but there's multi-level marketing companies out there where that agent may only earn a 30% commission on that when they should be earning 90 to 100% of that target premium. Those agents are taught to sell target premium. Now, target premium just tells you how much commission an agent makes. It is not, which it kind of makes it sound like if you tell me you want to pay $3,000 a year, targets, it kind of sounds like goal. And so these agents get taught, you know what? 3,000? Okay, that's the target. That's the target premium. If that's what they want to pay, that's the target we want to reach. And so they design it so that the target premium matches what they want to pay. And that is not the way to sell life insurance policies with a good design. We want to design it so that what they want to pay, the maximum amount that they want to pay, is actually right at the MEC limit. And that target premium is as low as possible. As low as possible. I was designing a policy for a guy earlier today, and the death benefit was going to be about $7 million. And I always like to illustrate the different designs and how that affects commissions. And so if I was to design it the way this person designed this universal life policy, the maximum amount, so this guy wanted to put in $300,000 a year for 5 years. If I designed it the bad way, my commission would have been $115,000 for that first year. $115,000. That guy would have had about $30,000 in cash value in the first year. Now, you look 20 years down the road, and just by putting in those 5 years of payments, he would have been able to pull out in retirement probably about $430,000 a year in retirement every single year. That doesn't sound too bad. You put in $300,000 for 5 years, you pull out $430,000 every single year in retirement. That's actually not too bad, right? And for the most part, yeah, I mean, I could sell that policy if I had him look at that, and if he didn't need access to that money in the first few years, which this person told me they did not need that money in the first few years. And I told him, I said, don't tell any other agents that, because they will design a policy like this knowing that you're totally okay with that. And you see this $430,000 a year, and that looks just groovy. Well, when I tweak that policy and I optimize it a little bit, I design it with a spread that most other agents could do in any other with a lot of other carriers. Okay, that means minimizing the agent's commission a little bit, at least as much as you can with some other carriers. That drops the commission down to $29,000, and it bumped up what he could pull out in retirement to $496,000 in retirement. So an extra $60,000 a year just by reducing that first year's commission. Okay, $60,000 a year every year. Now, with the company that I used, I can actually design it even better with a better ratio that reduces the agent commission even farther. And so I was able to design that same policy, and it only pays out a $10,000 commission. And what that did to his income stream, that potential income stream, was it bumped it over $500,000. It went to like $506,000 a year. So the difference between me getting a $115,000 commission and me getting a $10,000 commission was about $80,000 a year, every single year in that person's retirement. So I always design it to maximize the cash flow. And it's not to maximize my cash flow. It's to maximize your cash flow. Okay, David said we sold at the worst time. Yes, we did. Yes, we did. You had 25 more. You sold those. I did too. I sold my last 6 as well when we were up at 490 today. So hopefully it'll come back down and we'll be able to buy back. Yep, waiting for a pullback. Me too. I can't talk about Piton, Docu, and VSTO because I don't know those companies. I don't have a history. I haven't researched them. They all finished in the green. Good. I'm glad they did. It's good on you and your portfolio. Oh, VSTO didn't. It's down. Yeah, I did think I saw VSTO down. Okay, Northwest says, okay, sounds pretty good. Want to set my daughter up with something for her future. All right. David says, James, instead of this, buy them Tesla stock. Here's the beauty of these policies. It's not an either-or situation. I can fund the policy, and I can pull that money out of the policy and then buy the stock. So it doesn't have to be an either-or situation. We get the death benefit. We get that benefit of the death benefit. We get that compounding growth. And we still have access to the funds. So that's the beauty of these policies and why I like to sell them and why I like to educate everybody on them. By the time they're 18, they'll be wealthy. Yeah, doubly so in this case. Top Gun says, James, when do you plan to use your plastic? It's PLASTIQ. Plastic.com. I'd love to jump on that bandwagon after you give it a shot. I'll let you know. I need to get on that this week because I think I can make my premium payments next week. So I want to get that started. I've just been too busy trying to pump out some videos for you guys. Let's see. David says, best way to secure your kids' future is buy them all of those stocks. That is a good way. That is a good way to secure it. I think the best way is to go through the policy first because we get other benefits besides that. So here's the thing. If I just bought them the stock, What happens if they pass away next year? Now I have stock that I could sell, and it really doesn't do me anything. I mean, or I could keep it and do something else with it, but it's not going to do anything to help me grieve. It's not going to do anything to ease the financial burden that we might be facing as a family because of that tragic situation. Now, if they had life insurance and I pulled that out to buy the stock, now I have the stock and I have a big death benefit that will actually help me get through the bad times. So much better off, in my opinion, to do both of those things and not just focus on the one. Oliver says, good Tesla day. Yes, it was. It was a great Tesla day. And David pointed out me and him missed out on a lot of the gains. Yeah, David and I ended up selling basically a few shares. I sold 6 shares, which was half of my Tesla haul in my Roth. I had 12 shares total. And he sold, I don't know, 30 shares or so when it hit 457. Because at that point, we still weren't sure that it was going to keep going up for the rest of the day. We thought maybe it would top off somewhere right around there and then come back down like it did the day before. But alas, it didn't. It kept climbing, made it up to 490. So we missed out on some of those gains. But it was still fun. It was still a good day, and we ended up selling the second half of ours at the top today. So hopefully it'll come down a little bit tomorrow. We can buy back in a little bit lower. Oliver says, might sell my other shares and go all in on Tesla. Well, you don't want to go all in. I don't know. Can't really say if you should or shouldn't, but it's hard to decide to go all in when Tesla's at its peak. At least temporarily. Now, you go all in and you're going to hold it for long term. Great, no issues. I'm a bull. Tesla long term. I think it'll be fine. But in the short term, it's always hard to buy at the peak on these squeeze days. So I'm hoping to see it correct and come back down, which would be a great time to get in before Tesla's added to the S&P 500 on the 21st. So Philip says him too. Yep. He ended up selling out some of them, I think. David, which kid has a life insurance policy? Well, both of my kids. I have 3 kids. 2 of them have life insurance policy. The third one can't qualify because he had heart surgery. He had a few different heart surgeries to correct basically what was a half a heart that he was born with. So my other 2 kids have 2 policies on them each. So Northwest Pearl sounds like robbery. I'm assuming you're talking about that poorly designed policy I talked about, or the poorly designed policy I could have designed for the guy and made a huge commission payment. That's why when you see people complain about life insurance, they always complain about these huge commissions that agents make. Well, yeah, we do have the ability to make big commissions, and a lot of agents make big commissions. I really hate seeing policies designed to make big commissions, which is part of my effort to educate folks and be transparent in how all these policies are designed and how they should be designed. It's because I hate seeing folks come to me like that guy did yesterday that had that really bad policy design, and he's basically out $33,000. So my suggestion, since there was no cash value in the policy, but there was some built up, there was a 11,000 built up. He just didn't get any access to it because of the surrender charges. Don't close that policy. You just ride that policy out. Don't put any new money into it though. He may have enough in there to at least keep that amount of insurance for a few years. I don't know how long it'll end up going, but actually my suggestion was to reduce the amount of insurance, because it doesn't matter if it becomes a modified endowment contract. That was the risk. That's the risk if you reduce the amount of insurance after you've been paying in it for a few years. Because there's no gains in the policy. So it doesn't matter if it becomes a modified endowment contract. So he might be able to reduce that insurance from the $1 million that was in it, which is way more than he needed for what his goals were. He could drop that down to $100,000 in insurance or so, and probably ride that out until the surrender charge is gone and then cash out. So that was my suggestion for him. David said Andrew Warren is all in Tesla stock. He only has one stock. That's scary. I don't know who Andrew Warren is, but I know a few people that are like that. Top Gun, we just did a mech test on your wife's policy, discovered she was eligible for an additional 12K in PUA. Nice. Nice. Yeah, it's always good to make sure you're getting right up to that mech limit every single year. That is the most efficient use of those dollars. Because if you want to maximize your policies, everything you can put in above the base cost of insurance is going to go to cash value, and it's going to compound. So we always want to try and max that out. David, how would you avoid them making a big commission? With a proper design. So the way that I design policies minimizes that commission, and I always go over, when I meet with folks, I show them exactly how a policy should be designed, what they're looking for. Because you know what? Even if you're not going to buy from me, you should at least know what you're looking at with whatever agent you're talking to, so that you can hold them accountable. And you'd be surprised, but a lot of life insurance agents watch my videos and learn how to design a policy that way. Or they sign up for a meeting with me and I show them how to design the policies in those free 20-minute meetings that I give everybody. So anybody that goes to my Calendly link, calendly.com/cashflowpro, you can sign up for a free 20-minute consultation with me, and we can talk about whatever you want. So I get life insurance agents that meet up with me and talk about how to best serve their clients, because they don't know how to do it. Nobody teaches them how to do it. When I first started in this industry, I was selling annuities and I was selling IULs. Well, I was trying to sell IULs, but there was no training. Like, they just give you a script and they just say follow the script. And like, I'm not comfortable with that. Like, I like details. I like to know everything about a product that I'm selling, because I got to believe in it. If I don't believe in it, I can't sell it. I just don't feel right selling it. That's why I contract with about 20 different insurance companies, because I want to have the best products available for whatever situation you guys are in, whichever one will meet your needs best. I don't look at it and go, this one pays me more commission, this one pays me less commission. I don't consider that at all. We go with what is the policy that's going to work best for you. And so, because this company didn't want to train me on what the products actually do or how they work best or any of the details with them, I looked on my own. And so I went on YouTube and I started looking and trying to learn as much as I can. And it was in that process that I stumbled across the infinite banking concept. And with that, I met Steve Parisi, who actually showed me how to design these policies, at least with Guardian and Mass Mutual. And from there, I was able to figure out the optimal design for an IUL. I actually mostly figured out the optimal design on an IUL myself before that, much to the consternation of the company that had hired me, because it really reduced the commission that I was going to be able to make. But I was so excited about designing these policies and getting so much more cash value. I didn't even realize, I didn't put all the pieces together as to what that meant and how poorly designed all the other policies that people were doing and selling. So anyways, I met Steve Parisi. He showed me how to design whole life policies. So I got contracted with Guardian and Mass Mutual through him. Now I'm also contracted with Penn Mutual through directly with them, and I'm contracted with a whole bunch of other carriers that do IULs. But I really only sell two IULs. And of those two, lately I've only been doing one, and that's Allianz. Allianz has the best cash growth potential IUL. And that has to do with the index options that they offer and the bonus options that they offer. And they have really good guarantees that come along with that. So that's my favorite policy, my favorite carrier, and my favorite product when it comes to potential cash growth. They just happen to be the one that allows me to minimize that commission more than every other carrier as well. So if I take that same designed policy, it's not going to perform as well on from other carriers, because they force me to have a higher amount of death benefit in the amount of insurance that pays me a higher commission. So, it's not bad. If somebody wants to have a different company, great. Okay, I mean, we can sell one of those policies. It'll be better in my pocketbook. But that's a decision that you guys have to make. Like, that's not a decision that I want to make for you, because that puts it in my best interest. So I want to make sure that you guys have all the information that you can, so that you can make the best decision for you. Inevitably, I think that would end up going with a policy like the Allianz, just because everything that it has to offer. But it may not be, you know. And then of course we have whole life policies that have their place as well. So when cash value growth potential is not the number one deciding factor, maybe it's preservation of capital. Maybe you're shifting emergency funds or capital expense funds, or you have a lump sum of money that you just need to get into a policy and you want to be able to turn off all the premiums after that. Those are things that we can do in a whole life policy that we can't do in an IUL. So different strokes for different folks. We just got to figure out what's going to work best for your situation. Nayan says, what insurance companies do you recommend for whole life and IUL? So for whole life, Guardian, MassMutual, and Penn Mutual are the top three that I like. Those three are like the top dividend paying companies for basically historically speaking. Okay, and we get really good cash growth out of them as well in the long run, and we can design them with a lot of cash value growth in the first year. Now, of those three, Guardian is my top choice because of the flexibility that they offer, but Guardian does have its limitations when it comes to the ability to put in 10 times the base premium for a long period of time. That's where MassMutual and Penn Mutual shine. They have different paid up additions riders that allow me to do a maximum funded design that puts in, if my base premium is $5,000 a year, you could put in $50,000 on top of that. I can design a policy like that with Guardian where we can do that for 7 to 10 years, and then it's going to drop down. You have to reduce it down to 5 or 6 or 7,000 a year after that. With MassMutual, Penn Mutual, we can keep that 50,000 every single year as long as you want to fund it. So the different riders in there allow a little bit different flexibility as far as that's concerned. But MassMutual and Penn Mutual require knowing exactly how much you want to put in each year. And so if you wanted to put in $50,000 a year, you have to get qualified to put in $50,000 a year. That's going to require you making enough money to justify that. And it's not really a secret, but insurance companies don't like the infinite banking concept. They don't acknowledge it. So if you want to, as part of the infinite banking concept, we try and put as much of our income through our policies as we can, a large percentage of our income. Insurance companies don't like that. So if you tell them that you make $100,000 a year and you want to put $50,000 a year into a life insurance policy, they're going to reject that application. They would rather you be down at like $10,000 a year. That's an amount that they would be comfortable with, about a tenth. Okay, you can do more if you make more than that, like a $200,000 a year. They may do 20%, so you might be able to do $40,000 a year if you make $200,000 a year. So that's MassMutual and Penn Mutual. They will have limitations like that so that you may not be able to put in that much. So if we set it up to put in that $5,000 or $10,000 a year and you try and put in more than that, they're going to require you to go through underwriting in order to be able to do that. Whereas with Guardian, we can set it up to be $5,000 a year is all that they expect of you, but you can put in up to that MEC limit at any point throughout the year. So they have that flexibility. So we really just try and figure out which one works best for you. So that's whole life. And then when it comes to IUL, Allianz, National Life, Mutual of Omaha, F&G, Fidelity, and Guarantee Life. So those are four that I like how I can design their policies. Transamerica also we could do. But of those, the one that stands out is Allianz. Like head and shoulders above the rest. Head and shoulders. Top Gun reminding everybody to hit the like button. Mosh, how much did I make on Tesla today? I don't even know. Not as much as I would hope to make, because I'm basically, my profits are going to come 2 years down the road. I have some deep in the money calls, and so all of the movements right here, I'm not seeing any I'm not seeing any benefit from it, at least with those deep in the money calls that I have. I make my money on those by selling covered calls. And the covered call that I have sold right now is up at $570. So as long as we don't go over that 570, well, even if we did go over that 570 right now, no big deal. But I basically, if it goes through your strike price on the covered call that you sell, you're going to be losing money on that covered call that you sold. So it makes it challenging to to gauge your profits. When that one's showing a negative because of where the price is at, and your other ones are showing a positive, but it might be a smaller positive. So I definitely made some money on those deep in the money calls. I think I'm up. Must be like $6,000, something like that, on those deep in the money calls. But the ones that I sold, I'm down like 10,000. But we're not going to go through those ones, and really, it has to go through those at expiration. So those calls that I sold will lose value every single day until it gets to the expiration date. So right now I'm negative 10,000, but even if the share price stayed at that, each day I still have a ways to go before the expiration, and I will no longer have lost all that money, because each day the value of that option that I sold loses value, even though I get to still keep that whole premium. So it's a little bit tricky figuring out how much we made. Now on my Roth account, I sold 12 shares. I think I made, what did I do? 6 shares. I made about $50 on those 6 shares. So there's 300. I made about 360 bucks, I think, in my Roth account just today on those Tesla shares. So that was pretty good. Pretty good. Elementor, how's it going? Aloha. Low roller, did I buy Bitcoin yet? Nope, not planning to either. Not planning to. That is not, I'm not getting any FOMO when it comes to Bitcoin. To each their own on that. Some people got in when the price was low, and that paid off handsomely. I'm not into buying at the height. And it's not really, I don't know, Bitcoin's not my cup of tea. We'll just put it that way. Elementor says, Tesla's done marinating, ready to start cooking. Nice, nice. Nayen says, thanks for the detailed response. You're welcome. You're welcome. Top Gun, what type of policy loan provisions does Allianz have? Allianz has some great loan provisions. So there's basically 2 different types of loan options that you can choose from. One is the participating index loan, which is the one that I use and the one that I recommend. That is a 5% fixed loan rate. It's fixed for the life of the policy. Will not go up, won't go down. With that 5% loan, none of your cash value gets taken out of the index. So your policy, all of the cash accumulated in your policy, is still going to grow each year based on the index that it's tied to. Now, the indexes that I like to use have no caps. Allianz is one of the only ones I'm aware of that offers no cap on a good performing index. In this case, it's a volatility index. There's 2 of them. And they give you 145% participation rate. In 2017, the actual return on that index, what it saw, was over 14% return. So what that means is we take that 14%, we multiply it times the participation rate, 1.45%. That gets us up to a 21% credit. Now, we're not done there, because I pay 1% asset fee to get a 40% bonus on my policies on that index. So you take that 21% and you multiply that times 1.4. So the actual credit that year would have been 30%, just right around 30% credit. So if I borrowed out all of the money that's available in my policy and I was in that index in 2017, I would have paid 5% for what I'm borrowing, and I would have got a credit of 30% on all the value that's in my policy, including that amount that I borrowed out. So it's a hell of a deal. Hell of a deal. And it's had a number of, that index in particular has had a number of good years like that. Over the last 15 years, it's averaged just under 8% return. That's not counting any of the bonuses. So you get a 40% bonus on top of that. It basically would have averaged over the last 15 years almost 12%. It was like 11.99%. Solid, solid, solid. Especially when you can't go backwards, you can't go negative. When you can't go negative, that means it's all compounding. It's all compounding year after year. Even when there's a negative year or a 0 year, you don't go backwards, except for the cost of the insurance. But when you take out those negative years, the compounding is just massive. If you think about it, if you're in the stock market and you get a 50% drop one year, you need to get 100% return in order to catch back up to where you used to be. With these policies, if it goes negative, you get a 0% credit, and the very next year, it starts over at that new rate wherever it ended the year before, and so as soon as it goes up, your value starts to go up. So it ends up looking like a stair, kind of like stairs, because any 0 years, it's going to be flat, and then the next year it'll go up. So yeah, really, really neat way on how those work. Let's see. Oh, and then the second loan option provision that Allianz has is it's basically a wash loan provision. What they do is in the first 10 years, they will charge you almost 3% for your loan, and they'll credit you about 2% for your loan. After the first 10 years, so 11 and beyond, they'll do a straight wash where they'll only charge you 2%, but you only get a credit of 2%. Sounds okay when you think about, 2% loan, that's great. Yeah, that's good, but you're only going to get a 2% credit, so you're limiting your upside. In the case of that 2017, you're going to miss out on a whole lot of gains, depending on your loan size, but you're going to miss out on a whole lot of gains by not getting that 30% and just getting that 2% credit instead. So I like the participating index loans just for that reason. I would rather know that I'm going to pay 5%. I'm okay with 5%. That's a pretty good loan rate, regardless of what the interest rate environment is out there. So we're in a low interest rate environment now, so that 5% seems like, maybe it's higher than what I could get somewhere else. But if we get back to a different interest rate environment where car loans are 8% or 10% or 12%, which they were not even 20 years ago, that 5% is going to look pretty nice. It's going to look pretty nice. So those are your two options for Allianz. Mosh says, nice, happy to hear. When does your options that I sold expire? So there's the challenge. The options that I sold don't expire until 2021. So they're a ways into 2021. And I moved into that one because I had been selling options at 470, and I just happened to get out of that one and move it to 570, knowing that we're going to get the S&P inclusion anytime soon, and also knowing that, I expected we're going to have a big fourth quarter. So I didn't want to be at 470 if we were going to hit 500 by the end of the year, which I thought was a possibility. If I would have been at 470 when this ran up, I would have been in trouble. I would have had to try and roll it at that point when it was at its max value. So instead, when Tesla went down last week, down to like 408, that was when I rolled it. So I was able to roll it into, for the same amount of money that I had sold. Actually, I even got a little bit more money. So I had sold that 470 for, I don't know, $6,000. I sold two of them for like $6,000, maybe a little bit more than that. I was able to I sold those for $8,000. I was able to buy them back for about $6,000 and then sell the 570 for about that same amount, a little bit more than that, about $7,000. I sold the 570, which was a little bit farther out. So I was able to give myself another $100 in space just by making that roll. And it really saved me for this week, because it wouldn't have been nice to be at 470 if Tesla takes off and doesn't come back down, which is a possibility once everything gets settled down around here. What about NEO? Do I own NEO? I do not own NEO. I did own some puts. I still have a couple of puts on NEO, I think. Might have sold out of those. But I did buy some puts. I like NEO, and I'm a fan of NEO long term. I think their market, the Chinese market, is huge. A lot of potential and tons of room for growth. And it's not going to be one winner in that market. I think there's definitely room for a few winners. I like Xpeng, I like NEO, and I like Tesla in that market. I don't know too much about Li Auto, but that's another one that seems to be doing very well over there. And then BYD. But Xpeng and NEO, I'm sold on those two long term. I'm planning to buy some deep in the money calls for them, probably fairly soon. Probably when they retrace from their highs that they're at right now, because I think they went up too quickly. I think they went up too far, too fast, and they're going to come back down once all the excitement around the EVs settles down here in the short term. So right now Tesla's pulling everything up. All the excitement around Tesla. Earlier this week, it was NEO. The excitement around NEO pulling everything up. And the good earnings report from Xpeng pulling all of them up. So it's been a really good week for the EVs. They've all been going up, but they're all up too high for the amount of vehicles that they're producing. So NEO just doesn't produce enough vehicles to justify the price. A lot of that price is going to be future potential, and I understand that. But even accounting for that future potential, I think it's too high. Because there's not going to be enough investors willing to sit on it for that long in order to keep that price up in the short term. So I expect once it's not the shiny object anymore, which is going to happen any day now, once it's not the shiny object, all the people who are just traders, not investors, all those traders are going to move to another stock, because they're not going to sit in NEO for the next 5 years. The people that believe in NEO are going to sit in NEO, but that's not going to be enough to keep that stock priced up too high, which is, in my opinion, too high right now. So we'll see that come back down. So that's why I don't own it now. But when I do get it, I do plan on buying that deep in the money option, probably about 2023. Those are the ones I like to pick up as far out as I can go. It ends up being cheaper. So when it comes to maximizing my cash flow, that's one way that I do that. So rather than buying 100 shares, I buy an option to buy 100 shares. And that option is about half or a third the cost of 100 shares. And I can take that option and I can sell covered calls with it, which reduces my cost of that option. So ultimately my goal is to completely pay for that deep money option with selling the covered calls. I'm going to completely pay for that and make some profit along the way, because I've got 2 years to sell that in the meantime. So my hope is pay that off in about half a year, pay for that option, make premiums all the way up until that option is ready to starting to get a stuffy nose. Until that option is ready to claim, and at that time the share price should have gone way up, and I have the option that's already been paid for. I have the option to pick it up really, really cheap. So that option is just going to go up in value by a lot. So that's how I approach dealing with those companies that have really good growth in the long term, but we have no idea what they're going to do in the short term. No idea. Or how long it'll take them to get to that point. So I like giving myself a couple years. Mosh says, going all out on TQQQ in your Roth. Going to be adding shares as you go on in life. Have 21 now. If you keep adding till you're 60 in 40 years, what do you think my account be worth? In the millions? Question mark. I don't know. So TQQQ, I don't know how that works exactly. TQQQ just matches an index. I don't know if that's something that you should be in long term. I think it's something that people are supposed typically you just get in and out of it in fairly short terms, fairly short time frames. It doesn't mean you can't keep it for long term, but I know that a number of years ago, Wells Fargo got fined massively. I think it was Wells Fargo. Got fined massively because their brokers were basically selling their clients on getting into and something tied to the index like that, triple Q. And it was not the right type of wasn't the right type of investment for what they were selling it as, which was they were selling it as a long-term investment. Now I may be having some of those details confused. I just remember reading about this or hearing about it earlier this week. But it was something like that. So anyways, yeah, I don't know. T triple Q is so up and down. It just moves with 3 times the amount. It moves at 3 times leverage. I haven't followed it long enough, so I don't know. I don't even know if it's something that'll be around. Because what happens? So the flip side of that is S triple Q. That's the shorts on triple Q. So every day, that triple Q goes up in value. Right now, it goes up in value, and the short goes down in value. Now, if we see a drop, those reverse a little bit, but it only reverses for a little bit of time, and then they keep going opposite directions. And so S triple Q is down at $20. What happens when it gets to 0? Because it's going to get to 0. If it's a triple leveraged on the short side, it's going to get to 0, and it's going to have to start over somehow. What happens then? Does it just close down? Does anybody that's been in S triple Q for a while, are they just out because now their shares are worth nothing? What happens on the flip side? What happens with T triple Q? I don't know. But those are the things I would look at before I decide long term to get into something like T triple Q. So it is not a business. So it may not be around in 40 years. What causes those to not be around? That's what you should look into, because that's going to be where your risk is going to lie. Top Gun. When can you start using policy loans with Allianz? 1 year? You can start using policy loans with Allianz within the first year. So I was able to tap into my Allianz policy within the first month. So very good. And Top Gun, thank you for the tip. Much appreciated. I love it when you guys tip the dealer. I'm your dealer, right? I'm your dealer. It's just like you're sitting down at a blackjack table, and when you're doing good, when things are winning, you tip the dealer. So don't forget. We got to keep the lights on here somehow. Either that or just join my Discord. Join the Discord. You do that by becoming a patron for as little as $1 a month. Helps to keep all the lights on here. Gives me motivation to keep coming back and helping you guys out, providing all these live streams. I mean, I enjoy it anyways. I'm gonna do it whether you tip me or not. But it's always good to tip the dealer. So don't forget. BDN, forgot about this session. Hey, that's okay. We're still going. Mosh says very interesting. Thanks. You're welcome. Hope it helps. Let me know what you come across. So if you start digging into that triple Q, let me know the answers to those questions, because I don't know. Those are just the things that I would want to know the answers to those in order to be comfortable in that kind of making that kind of a decision. Okay. All right. I am going to play Top Gun's voicemail. So this is going to earn him another t-shirt, or maybe the socks. So let's see what Top Gun has to say.
Hey, James, this is Top Gun Bobby. My question is a little different tonight. What is your favorite book and why?
What is my favorite book and why? So this question is not narrow enough for my preference, because I've read a lot of books. It's really hard. I do have some favorites. But different genres. Different favorites and different genres. So that's why maybe it needed to be narrowed down. In what genre are you talking about? So let's go. When it comes to fiction, Ruby-Doo. Hey, thanks for subscribing. Welcome to the channel. When it comes to fiction, I would say there's a couple of them that I liked a lot. I liked so many books that I've read, but The Smoke Jumper, the author is Nicholas Evans, I believe. Awesome book. That one is one of my tops of all times. Let's see. That one came out a long time ago. That was the same author that did The Horse Whisperer, and that was a really good book too, actually. But The Smoke Jumper was just absolute favorite. And then we also have a book from is it Robert? What is his name? It's All Our Yesterdays by Robert Parker. Robert B. Parker. All Our Yesterdays. Loved that book also. Those are both non-fictions. Really, really good. Really, really good. There's some series that I like that were really good as well. I don't get to read any of those kind of books anymore. I spend all my time reading education stuff now. So when we move on to nonfiction, my favorite books, I happen to really like the two books that I have in the description: Retirement Miracle and Becoming Your Own Banker. And those are for different reasons. They go over concepts that are very pertinent to what I do for business, and they do it in a very good way. So I really appreciate those books for what they have to offer in that sense. I actually like to read textbooks. So I've read some business management books that are really good, but they're textbooks. I couldn't even tell you who the author is or how to find them. Business management books, a lot of good ones there. I really liked The Theory of Everything. I think that was who was that? Was that Carl Sagan, or was that Stephen Hawking? I think it was Stephen Hawking's Theory of Everything. Really great on the universe. So yeah, there's a few books. If you want anything more specific, feel free to ask more specific question, and we can tighten that up a little bit. But I think that about covers it. I mean, I've read books on economics that I like as well. I used to do a lot of reading. Now I spend my time watching YouTube videos, learning from YouTube videos, and most of my time right now is spent learning options. So that's been my effort for the last month, is learning options, as well as I'm always trying to expand my knowledge in my line of work, so surrounding life insurance, whole life policies, and IULs. Let's see. BDN says, by the way, he got options approved from Fidelity. Nice. Yeah, that was in your retirement account. Say, I need to move. I can't do options in my retirement account with Webull, unfortunately, but I'm actually doing pretty good in that anyway. So even without being able to do options, I put $6,000 in my retirement account with Webull last month, and I'm already up to $7,500. So that was solid. So speaking of Webull, I'm gonna share my referral link, because if you want to get some free stocks, Webull is the place to do that. You can get 4 free stocks for signing up with Webull using a referral code. You got to make sure you use a referral code. Otherwise, they don't give you all those free stocks. And when they give you those free stocks, they also give me free stocks. So that's why I would appreciate it if you used my referral code. So there's the link to it. There's the link to my referral code. If you want to join Webull, if you put in $100, you get those 4 free stocks. And those 4 free stocks can be valued up to $1,600 for each stock. Now, I have never gotten any that high, but the minimum amount is usually right about $8. So you deposit $100, you could get about, at minimum, $32 in stocks for free. And you don't even have to spend that $100. You could just pull that $100 back out. So it's a pretty neat deal. If you haven't joined it, I suggest you join it. Webull offers some of the best data out there, especially for free. But they get news articles, you get all of the financial reporting on the stocks, you get profiles, so you can look up any of the companies that's listed in there. Even companies that they don't sell shares for, you can get information on. So Webull is really great for the data. So check it out, use the referral code, and let's both get some free stocks. But my retirement account's in there. Webull does do options, just not for retirement accounts. So it's unfortunate, because I really like to do options. But knowing that I can't do options in my retirement account, I take a little bit different strategy, and it seems to be working pretty good. So I I'm actually pretty happy with how that's working. I was planning on switching out of that account and going into another brokerage firm that I can do options with my retirement account. But if I keep doing really well the way it is, I might just leave it for now. May just leave it. Top Gun says, remind me, can I do options in a 401k? Yeah, sure. Sure. You have a solo 401k, and with your solo 401k, you can get a brokerage account just like anything else. So you just need to get if you want to do options with it, you got to go with a brokerage company or a brokerage that will allow that, because not all of them allow that. So Fidelity apparently does. BDN had to go ask for special permission to be able to do it because it wasn't letting him do it. Let's see. TD Ameritrade, I believe, allows it. Interactive Brokers allows it. So I'm looking at opening. Right now, I'm actually opening a TD Ameritrade account. And I'm opening that for a business account. So I'm doing an Oregon Cash Flow Pro brokerage account with TD Ameritrade. And I'm planning to do some videos. On what I'm doing in that. So that's something I would like some input from you folks. And I'll talk about it during the morning live streams too. But what I'm planning to do is I want to do some kind of challenges where it's like we'll take $5,000 and see how long it takes us to get up to 100,000, or we'll do 25,000 to 100,000 challenge, or 25,000 to a million challenge, something like that. Something that won't take, probably not that, because I don't want it to take too long. I want to have something that's exciting to watch and not going to take forever to see the benefits from. So maybe it's like a $1,000 challenge, and you guys pick a company, and I pick how to do the trading on it. And so we just take $1,000 that week, and we figure out how to make money with whatever company you guys pick. And so I'm thinking I might do something like that, where I put out a poll on Twitter and maybe on my Facebook, and depending on what companies or the results of the poll, we'll go with whatever company gets chosen. So something like that. So these are ideas I'm tossing around in my head. So if you want to weigh in on that, let me know. C, is there a difference between investing in a Vanguard total stock market fund directly with Vanguard versus investing in the Vanguard total stock market ETF on Robinhood? I think there is. I think the fees are higher if you do it in the ETF on Robinhood. If I recall, Vanguard offers the lowest fees on their total stock market fund if you go through Vanguard. But they charge, they allow other brokerages to offer that, but they charge them some money. So you might look into that, because I haven't. This is just, I recall hearing this in one of the podcasts I listened to. But I recall there being different charges if that fund makes itself available to other brokerages. Because Fidelity does the same thing. I think Fidelity has a total stock market fund as well. That they allow other brokerages to sell. So you might check into that. Mosh, will Tesla get to 570 before your call expires? Maybe. But if it does, by then it won't matter, because it'll have reduced in value so much, and my long calls will go up $130 before they get to that point. So my long calls are going to gain in value as the stock price goes up, while that call that I sold is going to lose value every day. So by the time it gets to, let's say it gets to the date of my expiration, and the stock price has gone up to $590. Well, the difference between 570, where I'm going to sell it at, and 590 is 20. So I would miss out on a potential of $2,000 in growth. If I just let my call expire there, and I cashed in on my put, I cashed in on my call that's long, but my call would have gained probably $20,000 to get to that point. So I would still be $18,000 up at that point. I mean, it's probably up. It would probably be up more than 20,000. Let's see. I think I picked it up when the share price was around. Well, no, I get my option. I get to buy it at 400. So 400 and 570. That's $17,000. $17,000 plus. When the other one expires, that'll still be worth more than that. So yeah, it'll probably be worth 25,000 or so if it's up that high. Maybe even 30,000 by the time it gets to the expiration date of my call that I sold. So I'll probably net $25,000 to $30,000 if I just get rid of both of them at that time. So, but odds are if we get to that point and it wants to go over 570, I'll probably roll it. I'll probably roll it and sell another call and earn some more premium for doing that. And I'll move it up. I'll move it up even farther. So that's how we get out of those calls that we sell without getting into trouble. Now you can't always do that. You got to do it before it gets to that strike price. If you don't, it's going to cost you some money to get out of it, or you're going to have to move a lot of months down in order to get out of it and not have to pay some money to get out of it. So it becomes a challenge. If it goes up too far too fast. So what I have to keep in mind is when I'm selling those covered calls, I got to sell them far enough outside the money that it's not going to pass through that strike price. Otherwise, I just got to manage it. I got to move it. I got to try and push it out and get more premium. But I end up losing money that way. I end up losing a little bit of money that way. Okay? So it's not as efficient. Top Gun, how about some how-to vids with TD? You like their platform. You wish Tastyworks did something with 401ks. Oh, you use Tastyworks and they don't do anything with 401ks, huh? I'll definitely do something with TD and their vids, because Thinkorswim, which is what TD Ameritrade uses, it looks like a pretty neat platform. It's got a lot of detail and a lot of charts. I haven't actually got a chance to use it in person, but I figure once I get access, then I'll start learning about it. And I'm kind of excited. It doesn't look like it's going to be a different feel than like Robinhood, which I really like options on Robinhood, but it's slow. Robinhoods are a little bit slow doing the trades, just because you have to push too many buttons. Whereas with Thinkorswim, you can set stuff up to go really fast. So it'll definitely take some getting used to. And I won't do any how-to vids until I get that figured out. But good suggestion. C with a follow-up question. If you build a portfolio on Robinhood, then withdraw later on, will you be hit with a ton of taxes? Yes. Yes, you could. So anytime you withdraw, you're essentially cashing out your stocks. If you sell your stocks and you have gains and it's been less than a year, you pay regular normal taxes. It's called short-term capital gains taxes, which is the exact same rate as your personal taxes. If you hold on to stocks for longer than a year, then you get long-term capital gains taxes, which are a lot less. Depending on your income, it can even be nothing. So you got to check into that, see what's going to work out with whatever your trading style is. Currently, I'm doing a lot of trading, and I'm just going to be paying the taxes on whatever gains I have, because I don't have a better option. Right now. I have a very small Roth account. It's only $6,000. Now it's up to $7,500, but that's not enough. I can't do day trades with that. You have to have over $25,000 in an account in order to not get dinged as a pattern day trader. So it really hurts my ability to do frequent trades, which I tend to like to do, which also can get you in trouble as well. So so there's kind of some benefits to not having that ability. You kind of have to slow down and make sure each trade is actually what you want to do. You can't just hop in and out. So yeah, that's you will get taxes. I'm gonna get hit with some taxes because of that. But if you can do it in a retirement account, great. Because then you don't have to worry about it. Follow up. C also says, is there a way to put your Robinhood portfolio in an IRA? No. I mean, not staying within Robinhood. So you can take Robinhood and move however much you can qualify to move into an IRA. So you can only contribute $6,000 a year into an IRA. You would have to open a brokerage account with somebody who does it, like Webull or Fidelity, somebody who manages Roth accounts. Robinhood does not do a Roth or an IRA. They don't do retirement accounts. So you'd have to open an account there, and then you'd have to transfer your portfolio into it. So you can do that without selling your stocks. You can transfer it in there without selling your stocks. But it has to meet the income limitations. So, and it takes a while too. So like I was looking at transferring it from Webull to Fidelity, and it was probably going to take like 6 weeks, which is, that's way too long. So I basically didn't transfer it. Z, good evening. And Stalin, good evening. Good evening to you. BDN says Charles S. I'm not sure what maybe that was the beginning of a conversation you were about to start, or a statement you were about to make. And you didn't get a chance to finish. How's Fidelity's trading platform? I actually don't like it. It's very bare bones, and I don't know. Maybe it's okay for trading stocks. I didn't even try to trade stocks. I looked at trading options, and I didn't like it. I basically went to Robinhood, looked up all the different share price options, or the strike price and the options, and then I would go into Fidelity and plug in the numbers to see before it would pop up with what the bid amount and the ask amount is. So it's really complicated. You have to basically choose your strike price before you can see what the ask and bids are and anything else that has to do with it. I didn't like it. I didn't like that at all. With Robinhood, you can just see it right there. With Webull, you can just see it right there. With Thinkorswim, you can just see it right there. It gives you all of the options and the ask prices laid out. Didn't work that way with what I saw in Fidelity. So pretty strange. BDN started to say Charles Schwab to switch to that. Oh, okay, for your 401k, switch to that. BDN suggests Charles Schwab. Okay. Top Gun. Yeah, Schwab. Yep, that's what he was talking about. Philip, opened a Roth IRA on Webull, thinking to use it to actively manage some retirement funds. Yeah, that's what I planned to do. Yep. So that's good. Good luck with that. Stalin, thoughts on Acorn as an additional account? I have Acorn, actually, and I've suggested it. It's definitely not something that you can actively trade. You just pick a generic, aggressive. I picked aggressive, but you could do aggressive or moderate or whatever the other option is. Type of portfolio, and then they manage it, and you have to pay for it. So it's like $1 a month is what they charge, which not too bad once the account gets going, but when it first starts out, that's kind of a high percentage. So my Acorn account is now up to, I think it's like $400. I started it earlier this year. I put $5 a week into it, and I round up whatever rounds up gets shoved into it as well. So I'm up to 400, and I'm up like 15%. So not too bad. So if anyone would like a referral to Acorn, I do recommend it for being able to. It's a good alternative to just putting your money in a piggy bank, right? Your spare change. It's a great place for putting your spare change and just to start just another stream of savings that you won't really think about. So let me share the referral code for Acorns on here. And it looks like you get $5 for starting out. Hey, and if you join, you get $5. The referral bonus they give me is $35. I don't know why they do that, but that's a pretty nice return. So please use my referral code. And if you want to open up multiple policies, you can have your wife open one up, and then you get the referral from them. Have them use your referral code, because you'll have a referral code at that point. Philip has Schwab, but not so happy with their platform. Oh, okay. Okay. Stalin opened it up for your kids. All right. Good. Good. There might be some tax consequences on that because it's not in a retirement account, and they do pay dividends that get reinvested. So I expect that I'll see some type of 1099 or something from them that's I have to pay taxes on the dividends each year. But I don't know because I haven't had them for a year. So that's just something to be aware of. Z channel. What is the hardest challenge starting a YouTube channel? Good question. Depends on where you're coming from. For me, I had never done videos before, never been in front of the camera, didn't really do any public speaking. I mean, I did a little bit, but nothing that I was comfortable with. So that was a challenge, figuring out where my niche was as far as content-wise and how I'm going to present it in a way that I feel comfortable doing it. That was a challenge. And then also, starting out, figuring out how to do all the video editing. So if you watch some of my early videos, they could be rough. The content is really good. Like I put in a lot of good information. And I go back now and I look at it thinking, I should add to that and do a little more. And then I'll watch the video I did back then. I'm like, dang, I covered everything in that video. That was pretty good. Except the way it was done makes me cringe a little bit. So I would play around with trying to figure out if I should do music on a video, if I shouldn't do music, if I should do different types of music throughout the video, what is going to be too distracting. All of these things that you got to figure out as a content creator can be very difficult to just make something that looks good. Somehow I managed to scrape together enough decent videos that I've got, we're getting close to 3,000 subscribers. Okay. So that's pretty good. I'm pretty happy with that. But I see some other folks that maybe just started a channel a month ago and they've got 100,000 subscribers. And like they don't do anything except sit in front of a desk and just talk to the camera. And it's like, dang, how come I can't get that? For whatever reason, I don't have that same type of appeal. Different content, though, also, you got to realize. Different content, and we bring different experiences to it. So whatever you decide to start in, and you pick your niche, figure out, Stockmo, yep. Figure out how to dominate that niche. You got to figure out what people want, what's going to attract them. For me, it's been like a slow, steady approach. I actually really like that it took me 2 years, almost 2 years, about a year and a half, to get over 1,000 subscribers. That's a long time. That was a challenge. But I wasn't putting out very many videos. I think it took me about that year and a half before I had about 100 videos. And so like the more videos you're able to produce and put out there, the easier it is because each video tends to gather 1 or 2 new subscribers. You may hit a big one that'll get you 50 or 100 subscribers. One of my videos out there has led to like 350 subscribers. So that was a really good one. It just depends. So a lot of it's going to be trial and error. Trial and error. But you just got to keep working at it. Let's see. Philip, wonder if he can transfer his Wealthfront to his Roth in Webull. What is your Wealthfront account? Is it a Roth? If it's a Roth, you can transfer it to a Roth. If it's a different type of retirement account, you could roll it over into a Roth. So you most likely can. I don't know why you wouldn't be able to. Stalin, concerning taxes, my wife does it all on TurboTax. What is the process on paying taxes on Robinhood, Webull, and Acorn? So I did taxes last year with Robinhood and Webull, and it was actually really easy because they just mailed me a packet or emailed me a packet, one of the two. And so one of them mailed me, one of them emailed me. And they have all the totals right there on the packet. So I was able to just go through it and see. I didn't have to input every single trade that I made, thank goodness. It just told me the overall profit or the overall loss. And so I was able to just plug those numbers into the tax software that I use. And I use Credit Karma. So I don't know how TurboTax works for that, but imagine it'll be fairly similar. I haven't gotten a return from Acorn yet. That'll be this year or next year. So I can't answer you for that one. Philip still doesn't understand Stockmo's appeal. I understand his appeal. He does stick to the obvious. But he comes across as an educator. He's a teacher by trade, and he used to be in the business. So people look to him as an expert. And even though like I watch his analyses and there's like really not much to them, like I could do those analyses, but I can't say that I used to be in the industry. And so it's not coming from an expert. And so it seems like because it's coming from an expert, a lot of people watch him, even though it really doesn't put out any special information. So yeah, I don't get it. I don't get how you get so many, but he's got something and it works for him. So congratulations to him for doing that. I like actually the Stock Guru. That guy, he's got about 9,000 subscribers, which is really good. But he actually does technical analysis, and he teaches you how to do technical analysis. Now he's doing it because he's trying to sell a course. So what holds his numbers down, I think, is he's constantly trying to sell his course. But his goal in doing those videos is to, one, sell the course. But the reason he wants to sell that course is, to make money, but also so that you learn how to do the technical analysis that he's doing on his videos. And he's absolutely nailed top prices during the day and finish prices, movements on SPY, Tesla. There was a day that he said he did a Tesla one, and he said he puts it out in the morning before the market starts, and he said, look, based on this analysis, it looks like we're probably going to hit 418 today, and then it'll come down. And that's exactly what it did that day. He did the same thing with SPY. He did the same thing with Dow Jones. Just freaking nailing it. So really good. So check him out. If anybody's interested in some good technical analysis, I'd recommend the Stock Guru. He's got me about ready to buy his course. So if any of you are in our Discord and you want to go in on that with me, it might be worth it. Stalin says YouTube is like the stocks. What do you mean by that? YouTube is like the stocks. Oh, starting YouTube beefs is one way of gaining views. Yeah, well, I'm not interested in starting any beefs. Philip, Wealthfront is a Roth. Oh, yeah, you should totally be able to transfer it then. Because the way the IRS treats your Roth, it doesn't matter how many you have, you only have one Roth. You just have it broken up into different places. So you can definitely consolidate those if you need to or if you want to. Philip, can you roll a traditional IRA to a Roth? Yes, you can. You'll end up paying taxes on it because your traditional is pre-tax and your Roth is after tax. But you absolutely can. It's called a conversion. It's called a Roth conversion. Stalin, starting YouTube beefs. Oh yeah, one way of gaining views. Z Channel says he follows Stock Guru daily. Heavy. He was right about your Apple that day too. Yeah, he's hit a number of them. I've been very impressed. Very impressed. That's why I said he's basically got me about ready to buy his course. So let me know if anyone's interested in splitting that. We'll see if there's a way we can go in on that. Cut that price down. I think it's a couple $100, which doesn't seem too bad, but I don't know what all it entails. So I'm always interested in learning more though, and for somebody that keeps nailing those prices, he's got to know something. He's got to know something that can benefit from. All right, not seeing any more questions. We've been going for an hour and a half, so I'm gonna call it a night. Give my voice a chance to rest. I'm feeling a lot better, but best if I don't talk for too long. Still got to do my workout for tonight. Mosh says he's so upset he missed the early Tesla days. All of your calls have been super bullish. Pre-battery day earnings, and this year it didn't happen. Bummer. Yeah, I missed the early Tesla days too. So did I. Not by much either. I mean, I got in before the split at least, but not very soon before the split. Not soon enough that I was able to make a whole lot of profits that I didn't directly lose right after the split when it dropped. So I actually had fun on the run up on the split, even though I didn't actually make any money on it because I didn't know to sell high at that point. I didn't know that I needed to take my profits while it was definitely at a high point. I should have at least taken half of my profits at that point. But you live and learn. Live and learn. Stalin, Workhorse is looking bullish. Yeah, Workhorse. I don't even know what's behind Workhorse's run right now, except that Tesla's doing really good. Hyliion too. Hyliion's going up as well. So right now Tesla's pulling up the whole EV market. And so was NIO. NIO was up until their earnings call yesterday, and now Tesla took over. And so Tesla's the one pulling up that whole sector. So it'll be interesting to see how it goes. If there's a day that they go backwards, if Tesla comes back down again prior to the S&P inclusion, if all the other ones get dragged down that same day as well, which is what I think would probably happen. So we shall see. We shall see. All right. Well, that's it. I'm going to play you guys out with some music. Thanks for joining me today. And Bobby, be sure to collect your prize. If any of you want to get in on this action, go to my website, OregonCashflowPro.com. Click on the button to leave a voicemail message and leave me your question. And then you too can be a winner of a nice book, one of the 2 books in my description, or a cash flow shirt. The shirt that says it's all about the cash flow, or it's all about cash flow. They're cool shirts, they're comfortable, and they look good. So get in on that action. I'd love to play some other voicemails. All right, good night, Mosh, Stalin. Good time for the sleepy tunes. Yeah. All right, I'm going to play you guys out with some music. Got some good tunes. Good tunes. Top Gun says, get a sweatshirt. He loves that. He loves those sweatshirts. He's got 2 of them. Very comfortable. And that's at our Teespring store, which I think I have the link to the Teespring is in the description as well. So you don't even have to ask a question if you want to just buy a shirt. So have at it. All right, guys. We'll see you tomorrow. And we'll see you next week for our Wealth Care Wednesday live stream. 6 o'clock next Wednesday. 6 o'clock Pacific time. Whatever that is in your time zone. So have a good night.